Hello everybody. Welcome back. I hope you people enjoyed the session yesterday, and hoping that we are going to continue the session with the same rigor and at the same time with the same determination, and we will inshallah be able to do a lot of questions pertaining to the areas that are examined on a frequent basis. So if I could just recall about whatever that we discussed in the yesterday's class. So in the yesterday's class, we actually talked about we discussed about the basic background to the audit. And when we talked about the background to the audit, so we actually discussed about that whenever we talk about the audit, so audit actually starts off, there is actually, I gave an audit overview. And what was that overview of the audit? I talked about that whenever we talk about an audit, the audit has got several steps. And what are those several steps for an audit? So when we talked about the various steps for the audits, we talked about it that the audit actually starts off from the tendering stage. And what is that tendering stage? That is when you are invited to court for an audit. So you actually court for an audit, you consider various matters, and then the engagement letter is signed. And once the engagement letter is signed, what happens is that we go for the planning stage of the audit, which actually requires us that we should actually develop an audit strategy. We should decide the overall direction that the audit would follow, and we understand the entity, we assess the risk of material misstatement, and then we develop the responses towards the risk. Then we talked about it that once you have planned for the audit, the second step is actually the performance stage of the audit, where you actually perform the audit procedures. What do we mean by performing the audit procedure? Performing the audit procedure actually means that you actually identify the risk, and once you have identified the risk, you try to actually try to figure out if that risks do really pertain or not. So we talked about it. Then we talked about the finalization stage of the audit, and the finalization stage of the audit was that you have got senior managers and you've got a partner or a manager who actually tests the entire work that has been done up till now on this audit, and then he actually decides if the sufficient and appropriate audit evidence has been obtained or not. If the sufficient and appropriate audit evidence has been obtained, then what he does is that he goes for the reporting, and if sufficient or appropriate audit evidence is not available, then what he does is that he asks you to identify, perform additional audit procedure, and try to actually gather more audit evidence so that he could actually draw a proper conclusion. So we talked about it, and then we move forward. We talked about the reporting, that then there is this reporting stage where you can have multiple types of reports, which could actually be modified report, unmodified report, which could actually be a qualified report, or then at the same time we talked about all these things. Then we move further. We talked about the audit planning, and when we talked about the audit planning, we talked about it that at the planning stage of the audit, what we actually do is that we develop a general audit strategy. We plan out the resources that need to be used for those audit. Then at the same time, we apply ACCA 315, which is actually about understanding of the entity and its environment and assessing the risk of material misstatement. So we actually talked in detail that what do we mean by understanding of entity. So we talked about that what needs to be understood with the entity. Then we also talked about that what needs to be understood with respect to the entity's environment. We talked about the internal environment. We talked about the external environment. So we discussed all these things. Once we had discussed all these things, the next step was we actually moved towards understanding the concept of the risk of material misstatement. That what exactly do mean by the assessing the risk of material misstatement. So we talked about the materiality, that materiality is a judgmental matter. It's something that's dependent upon the auditor, that what does the auditor considers to be materiality. We gave several the various thresholds used for the materiality includes the profit before tax or the total assets or the revenue, etc., etc. We talked about it. Then we move forward and we talked about the misstatement, and we talked that misstatement is actually when you don't comply with an accounting framework. And what do we mean by non-compliance with the accounting framework? So whenever we talk about non-compliance with the accounting framework, that is the various things which are mentioned in the accounting framework, we tend to at times ignore those things. So when we tend to ignore those things, so that is actually non-compliance of accounting framework, and that is considered to be misstatement. I gave an example that IS 16 property, plant, equipment actually. So we gave an example of IS 16 property plant equipment, in which we talks about the various thing which is about recognition criteria, measurement, initial measurement, subsequent measurement. So we talked about the various things, and what I did discuss was I discussed that um, that what happens is whenever we talk about the risk of material misstatement, so the risk of material misstatement is majorly linked to, or the majorly it is related to identifying that what could go wrong with the financial statement. So I talked about it, what could go wrong with respect to the application of accounting standard, or what could go wrong with respect to the assertion. So we discussed till here. Then we attempted a question called December 2014, question number 1, which was about Connolly Company. So we discussed the Connolly Company question, and this is what we actually discussed in the yesterday's class. So I hope. Okay, for those of you who were not here yesterday, uh, okay. Linda, okay, I could actually see your feedback that you're saying that I'm speaking quite fast. So it's just that I'm actually recalling from the what we did in the yesterday's class. I wasn't teaching anything new, so that's why I thought that I can actually go through it in a rush. Anyways, I'm gonna slow down a bit. That's what we discussed in the yesterday's class. We're going to move forward, and we're going to discuss further. For those of you who are asking for the webinar WhatsApp group, so yes, I will share the link. There is already a webinar, there is already a WhatsApp group, so we will actually share the link. Let's just move forward and discuss further. So I'm going to start discussing. We'll do that, Daud. I'll share the link later on. I'll share the link later on. Anyways, this is what we did in the yesterday's class. Now let's move forward. What we are going to do is that we are going to start off with the next question that we will do is the question number 1 of June 2015. This is June 2015, question number 1. It's June 2015, question number 1. Okay, so this is actually June 2015, question number 1. That's what we are going to discuss. June 2015, question number 1. I've sent across the handout to you people also. It contains the June 2015 question number 1. So if anybody of you wants to actually see that, it's there in the handout portion, or you can download it from the ACCA's website also. Okay, so here we go with respect to this June 2015 question number 1. Let's just have a quick discussion on this June 2015 question number 1. That what exactly the examiner says with respect to June 2015 question 1. This question, it says you are a manager in the audit department of Craigie and Company, a firm of chartered certified accountants, and you have been assigned to the audit of TED Company, a new audit client of your firm, with a financial year ended 31st May 2015. TED Company, a newly listed company, is a computer game designer and developer and has grown rapidly in the last few years. The audit engagement partner, Jack Hackett, has sent you the following email. So you read this thing about this Craigie and Co., which is June 2015, question number 1. Now, what does he say? He says that, hello, I have... So what he says is that there are several tasks I require you to perform in respect of the planning of the audit of TED company. I held a meeting with the company's finance director, Len Brennan, yesterday, and I've provided you with some information from that meeting. In addition, I asked one of the audit seniors to begin to carry out preliminary analytical review procedures on TED's draft financial, and the results of the review performed so far are also provided to you. He says, using this information and audit planning notes, in the brief, you are required to prepare briefing notes. In the briefing notes, you should discuss the matters specific to the planning of initial audit engagement, which should be considered in developing audit strategy. Number 2 is evaluation of the audit risks, which are to be considered in planning the audit of TED company. The third one of them is recommending the principal audit procedures to be performed, and with respect to portfolio of short-term investments, and with respect to the other thing. So now let's just move forward and let's just discuss. You see, in the yesterday's class, we attempted the questions and we actually talked about the concept of risk of material misstatement. And when we talked about the risk of material misstatement, what did we discuss? We said that risk of material misstatement is a risk that the financial statements will be materially misstated. Now, a lot of students actually have an issue when the examiner says audit risk. When the examiner says that evaluate the audit risk, and the students get sort of confused that what exactly is the difference between the audit risk and the risk of material misstatement. So first of all, I'm going to discuss that what exactly is the difference between the audit risk and the risk of material misstatement. Once I've discussed that what is the difference between these two, then I will start discussing that how should we actually attempt this question. So if I talk about the difference between the risk of material misstatement and the audit risk, so let's just have a quick discussion about this risk of material misstatement and audit risk. Whenever we talk about the audit risk, so audit risk is generally a risk that auditor expresses incorrect audit opinion. That auditor expresses incorrect audit opinion. So audit risk is generally a risk that the auditor expresses incorrect audit opinion. What do we mean by expressing incorrect audit opinion? Expressing incorrect audit opinion could actually means when you were supposed to give unmodified opinion, you actually gave a qualified opinion instead. So that's actually the risk of material. That's actually the audit risk. Why? You were supposed to actually give a different opinion. You ended up giving a different opinion. So that's generally audit risk. Now, we have studied at F8 level, which actually is that whenever we talk about the audit risk, we say audit risk is made up of, or it's a product of inherent risk into control risk and into detection risk. So audit risk is actually a product of these three things: inherent risk, control risk, and the detection risk. That's what we already study at the F8 level. Now, if I take this discussion forward from what we discuss in the F8 level, so inherent risk is actually the risk of misstatement. Inherent risk is a risk of misstatement because of the nature of business, because of the basically complexity of the transaction, because of complexity of transaction, or because of maybe possible complexity of the accounting treatment. So if there is a risk of misstatement of financial statement because of either of these: nature of business, complexity of the accounting treatment, or the complexity of the transaction, then that is considered to be inherent risk. Like for example, if we talk about a company which deals in mainly electronic items, so whenever you are dealing with electronic items, what happens is the electronic items, you need to give a warranty whenever you sell them. And when you sell them and you give a warranty, at times you might actually estimate that there is going to be a 2% claim. But realistically speaking, what it turns out, the way it turns out, you might end up settling 5% of the sales as claims. So the point is, when it comes to warranty, there is estimation involved, and whenever we have got estimation involved, the estimation actually leads to an inherent risk. Why does it lead to inherent risk? The reason behind that is the estimation could always go wrong, and if the estimation goes wrong, that means the financial statements have not been prepared correctly. So that is one thing that happens. So one of them is inherent risk. The second one of them is the control risk. And what is the control risk? Control risk is a risk of material misstatement or a risk of misstatement because of weak internal controls prevalent in the organization. Because of the weak internal controls. So at times you have got weak internal controls on inventory. At times you have got weak internal controls on other items like cash or payroll or etc. 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 So whenever you have got weak controls, the weak controls actually lead to a problem. And what is that problem that they lead to? They lead to a problem that the weak controls actually, they might result in some misstatements in the financial statement. So whenever we talk about the audit risk, we say audit risk is made up of inherent risk and the control risk and the detection risk. So we talked about this. Inherent risk is the risk of misstatement because of etc. The control risk is a risk of misstatement because of weak internal controls, and the detection risk is basically a risk that auditor fails to detect. The auditor fails to detect misstatement. The auditor fails to detect misstatement. So why would an auditor fail to detect misstatement? That is something that needs to be understood and that needs to be considered. Anyways, so we talked about it that this is what happens, this is what the detection risk is. Now let's move forward and let's just discuss further. So that was actually, unfortunately, I'm unable to deal with it in a proper manner. So this is number one. Number two. Now, so whenever we talk about the detection risk, as I said, it's a risk that you are unable to detect misstatement. Now, why would the detection risk arise? The detection risk could actually arise because of detection risk could be a sampling risk or could be a non-sampling risk. Whenever we talk about the detection risk could actually be a sampling risk. It could be a non-sampling risk. Now, what do we mean by sampling and what do we mean by non-sampling risk? The sampling risk is basically, you do understand that whenever we perform the audit, we actually draw some samples, and out of the samples then we actually perform the evaluation. So the sampling risk is basically the samples which are drawn do not contain misstatement. The samples drawn do not contain misstatement. And the second one of them is a non-sampling risk. And what exactly is the non-sampling risk? So let's just talk about the non-sampling risk. That what is a non-sampling risk? So whenever we talk about the non-sampling risk, so the non-sampling risk is basically you have drawn the sample, and that sample does include the misstated transactions also. But since you don't have much of an understanding of the entity, therefore you are unable to understand that this is a transaction that would actually be causing the misstatements. So this is actually considered to be a non-sampling risk. So we have got, whenever we talk about the audit risk, so audit risk is made up of inherent risk into control risk and into detection risk. You'll have to wait for a second as I think there was some technical issue with the system. So we're discussing about the sampling risk, and we were talking about that sampling risk is that the samples that you have drawn do not contain the misstated transaction. And when we talk about the non-sampling risk, so the non-sampling risk actually means that your samples contain misstated transactions, but auditor fails to understand them. So that is considered to be a non-sampling risk. So that's what happens. It's a sampling or non-sampling risk. So whenever we actually talked about this risk of material misstatement, so whenever we talk about the risk of material misstatement, so you need to understand that the risk of material misstatement is actually made up of inherent risk into control risk. So if I say that the audit risk, so I could actually say the audit risk, which is inherent risk into control risk into detection risk, could easily be explained as risk of material misstatement into detection risk. So if you think from the perspective, so it's very simple that the audit risk is actually a mixture of inherent risk, a risk of material misstatement and detection risk. So it's a risk that the financial statements will be materially misstated, and in addition to this there is a detection risk involved also. So whenever the questions requirement says risk of material misstatement, it's just inherent and control, and whenever the questions requirement says audit risk, it's inherent plus control plus detection, all these risks. So now let's come on to this question, which is actually question number one of June 2015. So let's come on to this question and let's just discuss. The question's requirement says discuss the matters specific to the planning of initial audit engagement which should be considered in developing the audit strategy. So if I say that if the question's requirement is, it says that describe the risk associated with the initial audit engagement. So I'm gonna discuss this, that with respect to the initial audit engagement, there are actually certain things that you need to remember always. There are certain things with respect to initial audit engagement which you always need to remember. And what are those things which you need to remember with respect to the initial audit engagement? The number one thing is that whenever we are performing an audit for the very first time, so the first thing is basically correspondence with outgoing auditor. So amongst the various matters that you will consider while undertaking the initial audit engagement, number one of them is going to be corresponding with the external outgoing auditor. Now, why would we correspond and what will we correspond? The reason behind that is, first of all, we are professional accountants and we should take a professional clearance. Now, what do we mean by obtaining a professional clearance? Obtaining a professional clearance actually simply means that you are asking from them that this client was being dealt by you and we are now going to be dealing with them. So we hope that you don't really have an issue, number one. And secondly, you inquire from the outgoing auditor that if there are any issues with the outgoing auditor, thinks that he should actually communicate with you. So you actually inquire from them, and if they could share the working papers with you also, so that you can have a better idea about the areas that you need to consider with respect to this client. So that's number one. Now, if I talk about number two, so number one was the correspondence with the outgoing auditor. The second one of them is basically under the whenever you undertake a new audit client. So understanding of entity. Now that is also important. You need to obtain the understanding of the entity also, because when it comes to a recurring audit, in the recurring audit, you don't always have to understand the entity. You just have to understand the simple changes. So understanding of the entity is one of the tasks that you need to perform whenever you are dealing with the initial audit engagement. And the third thing is, there is this ISA 510, which deals with the initial audit engagement. So it actually talks about whenever you are dealing with the initial audits. So in the initial audits, you need to consider about the opening balances. Now, what do we mean by the opening balances? The opening balances, what do we need to know? What do we need to do with respect to opening balances? So for the opening balances, what we actually need to do is that we need to do three things. I repeat it again. What do we need to do with respect to the opening balances? With respect to the opening balances, we need to do three things. And what are those three things? The number one thing is that the opening balances are correctly brought forward, and there is a consistency in accounting policy. So these are the two major things that you need to consider whenever you are considering the opening balances, which is consistency, which is the consistency in accounting policy, and that the opening balances are correctly brought forward. That is also one of the things that you need to consider. So basically, if the questions requirement says discuss the matters specific to the initial audit engagement, which should be considered in developing the audit strategy. So what you will do is that you would actually discuss about these matters which you think should be considered. And what are those three matters? Number one, obtaining of professional clearance. Number two is understanding of the entity. And number three is basically the opening balances. Now let's move forward. The questions requirement is evaluate the audit risk to be considered in planning the audit of TED company. So if I talk about this TED company's audit, so I would actually say that TED company's audit risk. In order to identify the audit risk, you know that audit risk is made up of risk of material misstatement and detection risk. So then again, it's not going to be much different from what we have studied up till now. All that you have to think is what could go wrong. So with respect to the audit risk, you have to think what could go wrong. What could go wrong? Right, so take 3-4 minutes. It's a 17 mark requirement. I told you yesterday also that whenever there is a 3-4 whenever there is a requirement of evaluation of the audit risk, so it's generally going to be half a mark for identification plus 1 mark for explanation. So it's going to be 1.5 mark. And if we talk about 17 divided by 1.5, that means the examiner is expecting around 12 risks from you. 10 to 12 risks is what the examiner is expecting from you, that you will actually tell or share with the examiner around 10 to 12 risks. So let's start discuss. Let's go through this question. I'm giving you 5 minutes time. Go through the question, then we'll discuss. Okay. Let's just start discussing about this question. So our requirement is we need to identify or we need to evaluate the audit risk to be considered in planning the audit of TED company. Let's just start off. It says you are a manager in the audit department of Craigie and Co., a firm of chartered certified accountants, and you have just been assigned to the audit of TED company, a new audit client of your firm. Now, when we know that there is a client who is a new audit client of our firm, so the new audit client of our firm actually means that there is a detection risk. There is a detection risk which is actually a high detection risk. Now, you would say why? Number one thing is, if I talk about now, first thing is, you've got a new audit client. So whenever you've got a new audit client, so the detection risk is high. So number one risk is high detection risk. A lot of students actually do know that whenever there is a new audit client, there is a high detection risk. So what they do is that in the examination, they write it this way, that the audit risk in the given scenario are number one, detection risk. Now, and all that they write is the detection risk is high because this is a new audit client. Examiner has specifically identified such sort of comments, and the examiner says that such comments will not get more than half a mark. Now, how can you get more marks for this? Is that when you identify that there is a high detection risk, you need to be able to explain that why is there a high detection risk. So you should actually say that the detection risk is high. Detection risk is high because it's a new audit client, and since it's a new audit client, therefore there is a lack of understanding. There is a lack of understanding about entity. There's a lack of understanding about entity. So when there is a lack of understanding about the entity, so there is actually a likelihood that we might actually are unable to detect few risks, which could be because of the sampling and which could be because of non-sampling. So they could actually be sampling risk, they could actually be non-sampling risk. Now somebody asked in the examination, in this question window, that what is a non-sampling risk. So I'm again explaining it, that the sample that you did draw for the audit, that sample did contain the misstated transaction and you did review that. But unfortunately, because of your lack of understanding, you could not interpret or you could not understand that if that is a misstatement of that's a normal transaction, so that's what happened with you. So that is one thing. So you need to understand this thing. It's not just about high detection risk. It's about that the detection risk is high because it's a new audit client and we have got a lack of understanding of this client. That's why the auditor might fail to detect the misstatement. So that's one of the risks. The second one of them is with a financial year ended 31st May 2015, TED company, a newly listed company, is a computer games designer and developer and has grown rapidly in the last few years. Now, one more thing, I did mention to you people yesterday also, and what did I mention actually? I mentioned to you people yesterday also that whenever we talk about that a company is going towards obtaining finance. Now, whenever an entity is obtaining finance, so the entity definitely wants to show a good picture to the finance provider. So when the entity intends to show good picture, that means the financial statement would be subject to the management bias. So here in this case also, the TED company is a newly listed company. The TED company is a newly listed company. And now, if it's a newly listed company, we are not too sure if it was listed in the current year or not, but if it's a newly listed company, that means the financial statement could be subject to management bias. The financial statements could be subject to management bias. Now, let's move forward. So we discussed about this, and the third one of them is basically TED company was formed 10 years ago by Douglas Doyle, a graduate in multimedia computing. The company designs, develops, and publishes computer games, including many highly successful games which have won industry awards. In the last 2 years, the company invested 100 million in creating game design to appeal to the broad global audience, and sales are now made in 60 countries. The software used in computer games is developed in these countries, but the manufacture of the physical products takes place overseas. Now, let's just try to understand this thing. There are certain risks. I did mention yesterday also that the audit risk is, or the risk of material misstatement is simply, you need to think what could go wrong. You just need to think what could go wrong, where could things actually go wrong. So now if I talk about it in this specific scenario, what I could figure out is number one of them is the 100 million investment in creating the games. In the last 2 years, the company has invested 100 million in creating the games, number one. Number two is that the sales are now made in over 60 countries. So over 60 countries are involved in the sales. And the third one of them is, it says that in this country, but the manufacture of the physical product, takes place overseas. So if I actually talk about it, so what exactly the way it is, you see, what happens is whenever you are dealing with this specific case, then what actually entity has invested the $100 million if the entity has invested $100 million in developing the games. So if it has invested $100 million in developing the games, then what will happen is that this would actually mean that the research and development costs have been incurred. So now I did mention about the risk pertaining to it, that one of the risks is that the research cost might have been capitalized. One of the risks is that the research cost might have been capitalized. That's one of the risks. And the another risk is that development expenditure does not meet the capitalization criteria. That's also one of the risks. That the development expenditure does not meet capitalization criteria. That's also one of the risks. The number fourth risk is basically you're dealing in 60 countries. So now if you're dealing with 60 countries, that means what could happen? This means that you will be dealing with the foreign exchange. Now, dealing with foreign exchange is a business risk. This does not lead to some audit risk. But I'll repeat it again. The audit risk is you need to think what could go wrong. So now what could go wrong with respect to dealing with foreign exchange? Dealing with foreign exchange is actually an inherent risk, because the reason is the exchange rates fluctuate quite frequently. And when the exchange rates fluctuate quite frequently, then what could happen is you can end up using an incorrect exchange rate. So now if somebody says that the risk is non-compliance of IAS 21. Now if somebody says that the risk is non-compliance of IAS 21, that's not going to give you marks. That's going to give you half a mark only. Now what will give you more marks? You will get more marks when you say that the risk is that the entity has actually used an incorrect exchange rate. You need to be more specific. The entity has used incorrect exchange rate. They have used the incorrect exchange rate to record transactions. Now let's move forward. Developed in this country, but the manufacture of the physical product takes place. Now next is it better now? Is the voice better now? Okay, just wait for a second. Can you please confirm if the voice is okay now? No, sir. Okay, just wait for a second. Just wait, please. Okay, just wait. No? Okay, can you please confirm to me if it is okay now? Same problem. Okay, for the R&D, let's just talk about the R&D thing. Okay, just wait for a second. Let them. I'll ask the technical team to fix the matter so that the voice is not disturbed. Please wait. Please hold. Okay, so I would repeat the point of this research and development. I mentioned that you have invested 100 million in developing the games. So when you have invested 100 million in developing the games, what does this mean? This actually means that investment of 100 million, um, the investment of 100 million, it's not, there is a risk that they might have capitalized the research as an research expenditure as an asset, or there is a risk that the development expenditure does not meet the criteria for the capitalization and they have actually capitalized the development expenditure. So these could be the problems. Okay, I hope the voice is clear now. Anyways, we were on to it. Okay, Rabia, just wait for a second. Just wait for a second when you say that. I don't. I just let me actually clear it. Okay, I think that if the voice is having a problem, what I would just do is that I would try to stop the webcam. You might not be able to see me, but you'll be able to see the screen and see if it gets a bit better. See if it gets a bit better. Is it better now? Still no? Okay, anyways. Faris, this is not right. I mean, right now it's not the namaz time. There's going to be of no point. Okay, we talked about it. Then the next step is basically actually it says the computer games are largely sold through retail outlets, but approximately 20% of the tech company's revenue is generated through the sales made on the company's website. Now remember one thing, 20%, 25% of the tech company's revenue is generated through sales made on the company's website. In some countries, tech products are distributed under licenses which give the license holder the exclusive right to sell the product in that country. The cost of each license to the distributor depends on estimated sales in the country to which it relates, and licenses last for an average of 5 years. The income which that company received from a license is deferred over the period of license. At 31st May, the total amount of deferred income recognized in financial position is 18 million. Now, I would repeat again that I have repeatedly discussed this thing. You need to think what could go wrong. Whenever, let's just talk about the revenue recognition in this case. If I talk about the revenue recognition in this case, so whenever you've got online sales, so while dealing with online sales, you at times have got problems with the timing of revenue recognition. You've got the problem with the timing of revenue recognition. Now, what do you mean by problems with the timing of revenue recognition? Is that when should we recognize the revenue? Should we recognize upon receipt of order, or should we recognize upon the delivery, or should we recognize upon the receipt of money? So when should we actually recognize it? So it's very, very difficult. So at times what happens is that you have to ascertain that the timing of revenue recognition is correct. So when dealing with this online sales, and then the specific scenario, what could go wrong? What could go wrong is basically the timing of revenue recognition from online sales. That's one of the issues. Now, number two is that you could see that they are actually selling the licenses. So if they are selling licenses, so selling of license actually gives rise to income. But since the license is actually given for 5 years, therefore whatever income that you receive, you have to say it has cash debited and correspondingly deferred income credit. So what is the risk here? The risk over here is they do mention in the question that they have actually recognized the 18 million as a liability. They might have recognized 18 million as a liability, but the risk is of the 18 million. The risk is of the 18 million. I repeat it. Now, if the 18 million is the deferred income, then of the 18 million, what will happen is It's only going to be of the 18 million, you need to actually split it between the current and the non-current portion. Why do we need to split it into the current and the non-current portion? The reason behind that is when we talk about that 18 million, it would not be earned in the next 12 months. It will be earned over a period of next 4 years. So of that 12 million, of the amount that is going to be realized in the next 12 months, it should be shown in the current liabilities, and the amount that will be recognized after 12 months should be shown in the non-current liability. So now what exactly is the another risk? The another risk is what is another risk? Another risk is that it's not. Another risk is that the revenue is, the deferred income is not split between the current and the non-current liability. So another risk is basically so the current liability and non-current liability split is not done. That's another risk. Now let's move forward. It says as part of the 5-year strategic plan, TED company obtained a stock listing in December 14. Let's just check which year end are we working for. So if you're going to check the year end that we are working for, so you will find out that we are working for the year ended 31st May 2015. And in December 2014, the entity went for listing. So the point that I mentioned earlier, that if the company is listed in the current year, that means there is actually a risk of management bias. It says the listing and related share issue raised a significant amount of finance, and many shares are held by institutional investors. Decker Doyle retains 20% of equity shareholding, and a further 10% of company's shares are held by his family members. So you see, the chief executive officer has got a vested interest. He has got 20% of the shareholding. 10% is being held by his family members. So that means in total it's 30% within himself and his family. So there is another risk, which is that since you were there going for the listing would have actually meant that you targeted the institutional investors at its sale also. That means you would have tried to show a very good picture. Now, since there is a vested interest involved now, so there is a likelihood that there is going to be more, the financial statement should be continuously going to be subject to management bias. There is further risk. Now it says, despite being listed, the company does not have an internal audit department. It's a pure non-compliance of the Code of Corporate Governance. So the weak Code of Corporate Governance compliance indicates control, weak controls, and weak controls means control risk. So, and there is only one non-executive director on the board. So there is only one non-executive director on the board. And TED is hoping to resolve the next month as explained. So another risk is basically that you don't have, so another risk that exists is you don't have non-compliance of Code of Corporate Governance. The next step is actually recently a small treasury management function was established to manage the company's foreign currency transaction, which include forward exchange contracts. Now, I did mention about this thing that what is the inherent risk? Inherent risk is basically because of the nature of the transaction, because of the complexity of the transaction, and there is a risk that is considered to be inherent risk. Now, what does it say? It says that the company has recently formed a small treasury management function which is going to manage the foreign currency transactions through forward exchange currency contracts. Now, forward exchange contracts means you are dealing with derivatives. Forward exchange contract means you are dealing with derivatives. And the accounting for derivatives is a complex accounting. So whenever the accounting is complex, there is an inherent risk that the entity or the people in the finance function or the treasury function do not actually understand how the derivatives should be correctly accounted for. So there is then again a risk of material misstatement, which means there is an audit risk, which is that the complex accounting of the derivatives has not been dealt in a proper manner. That is another risk. Now, if I move further, it says the treasury management also deals with short-term investments. January 2015, cash of 8 million was invested in portfolio of equity shares held in listed companies, which is to be held in the short term as a speculative investment. Shares are recognized as financial asset at cost of 8 million and the fair value of the shares at 31st May 2015 is 6 million. You could understand, you do know that whenever we talk about the short-term investment, so short-term investments are classified as financial asset at fair value through profit and loss account in accordance with IS. They are classified as financial asset at fair value through profit and loss in accordance with IFRS 9. So now, if they are classified as financial asset at fair value through profit and loss in accordance with IFRS 9, then how do we actually deal with it? It should be recorded at fair value at each reporting date. It should be recorded at fair value at each reporting date, and any gain or loss should be taken to P&L. Now, up till now, the audit risk that we have discussed, we have majorly talked about. Up till now, the audit risk that we have discussed, what we have actually done is we have majorly talked about what could go wrong. Now, you need to understand one more thing. Over here, the examiner says that we invested 8 million into these short-term investment and they are being carried at 6 million at the year end. We invested 8 million into these investment and they have a fair value of 6 million, but we are still carrying them at 8 million. So now the examiner is telling you that we have not remeasured them. We have continued to record them at cost. And we do know that this is the incorrect accounting treatment, because the correct accounting treatment should have been that they should have measured it at fair value of 6 million and they should have recognized a loss of 2 million. So now, what to do then? What to do then is, basically, it's very simple. Now, what is the audit risk? We do know that what could go wrong. We know that something has gone wrong. Now, the audit risk is going to be the entity does not rectify accounting treatment of short-term investments. The entity does not rectify the accounting for the short-term investments. Now let's move forward. As listed company, TED is required to disclose earning per share figure. When it comes to listed companies, there are two specific IAS which specifically applies to listed company. One of them is IAS 33 and the other one of them is IFRS 8. So if you come across scenarios for the listed company and when you can actually see that they are actually having some disclosure based issues or etc. So I did discuss about one of the cases of IFRS 8 yesterday, but for the IAS 33, then again, there could be multiple risks. You see, IAS 33 itself, the calculation is complex, so there could be multiple risks. And what could be those multiple risks? One of the risks could actually be that non-disclosure. Number one of them is non-disclosure or incorrect disclosure. Or another one of them could be incorrect calculation. So another one of them could be the incorrect calculation also. It says is required to disclose its EPS. Becker Doyle would like this to be based on adjusted earning figure which does not include depreciation and amortization expense. So you see, the management bias that we were talking about is being reflected here. That the Douglas Doyle says that we will calculate EPS, but we will not show depreciation, we will not show amortization. Okay, now why would you not show? You should show. Why would you not show? The reason being, his intent is that he might actually go to fetch a better amount for the money or for the shares that is being held by him. The previous auditors of TED are a small firm called Crelly and Company. They resigned in September 14. Audit opinion on financials for the year was unmodified. Now, understand one thing. Usually what happens is, whenever you take over as an auditor, so it's very important to know that why did the previous auditor go? Why did the previous auditor leave? Now, over here in this case, the previous auditor might have actually left because the company became listed and the company or it became listed or it was about to be listed. So that's why it was not possible for a smaller firm to actually continue auditing this company. They might have resigned for this reason. That's one thing. But you need to inquire, and that is when we had talked about that you need to talk to the outgoing auditor that what were the reasons for his departure, or is there anything that he needs to tell or etc. etc. Now next. The next situation is basically that this small audit, it was a small audit firm, it has already resigned and it had issued unmodified opinion. Now one point is, usually the small audit firms, they have got a high dependency upon these clients. So usually they have no choice except for giving an unmodified opinion. Now what does this all indicate? This all indicates that there could be a reason, there could be an issue with the opening balances, that the opening balances might not have been correctly shown. So what does this all indicate? This all indicates that there could be issues with the opening balances. Now the next situation is basically you've got a results, preliminary results. The examiner has himself performed the analytical procedures. So if we could have a just quick look at the analytical procedures, revenue has grown up by 46.3. The GP has grown up by 62.5, whereas the operating profit has grown by only 30.4. Now there is something that is being reflected here. Now what is that something that's being reflected here? Okay, Linda, I would try to actually slow down a bit. Is it better now, Ali Chaudhry? Yeah, exactly. Now, one of them. Let's just try to figure out that what does this indicate? You see, there is a 46.3% increase in revenue. There is a 62.5% increase in the gross profit and a 30.4% increase in the operating profit. Now, what does this indicate? Let's just try to actually figure out. If you look at it, you see this is sales. If the sales, let's say, increase by, if the sales were 100 and if they have become 150, the COGS, generally speaking, if it was, let's say, 60, so it would also increase by 50%, it would become 90. And the result is going to be the sales minus cost of sale would actually give you the profit, and the profit is going to be 40. Similarly, over here 150 minus 90 is going to be 60. If you would see the increase over here, I've actually given this as a hypothetical calculation. If you look at here, it has increased by 50%, it has also increased by 50%, and this has also increased by 50%. If you calculate the GP margin, you would say 40 upon 100 gives you 40%. If you calculate GP margin, it will be 60 upon 150, gives you 40% again. Now what does this indicate? This generally indicates that if the sales increases, usually the cost of sales also increase by the same amount. But it's not necessary. But over here, the sales are increasing by 46% and the GP is increasing by 63% approximate. That means this indicates that the costs have significantly gone down. Now, why would the cost have gone down? You could see one more thing over here. Now, that is, what is that one more thing? One more thing is the operating cost, and that the resultingly the remaining amount is called operating profit. And the operating profit has increased only by 30%. Now what does this all indicate? There are two factors. One of them is there could be a potential risk of misclassification. There could be a potential risk of misclassification. Now what do you mean by misclassification? It is highly likely that you have classified the expenses which were pertaining to the COGS into the operating expenses. That's one of them. The second problem that might happen is that the entity's costs have gone down. So there could be misclassification and lose cost control. These could be the two factors which might have resulted in this whole thing. Now let's move forward. So if I see further, 46.3 finance charges, etc. The EPS is 89.6. It says the EPS has been calculated as follows. Profit before tax is given, the depreciation is added back, and amortization is added back. So we did discuss that this is incorrect. We did discuss that this is all incorrect. So this is not a correct calculation. The second one of them is adjusted profit before tax divided by the number of equity shares at 31st May 2015. If you could remember a bit of EPS from your earlier studies, you would remember this thing, that whenever we are calculating the basic EPS, so for you to calculate the basic EPS, you actually need to. For you to calculate the basic EPS, you need to actually, whenever we calculate the basic EPS, so when we talk about calculating the basic EPS, it's actually profit divided by weighted average number of shares. So what could actually be the risk over here? The risk over here is you have not used the weighted average number of shares. The only thing that you have used is the closing number of shares. The closing number of shares are not important. You should have used the weighted average number of shares. So that is also one of the problems with it. That is also one of the problems with it, that you have not calculated it correctly. So these are the few things which could actually be indicating the risk associated with this specific scenario. So I'm going to take your question. Okay, yes, we will have a namaz break in 2-3 minutes time. One thing that I would want to highlight over here is there was somebody who mentioned also that why are you not considering the percentages. So a very important point is, since we are here to attempt the question on audit risk. So audit risk is actually made up of inherent control and detection risk. Inherent control is also termed as risk of material misstatement. So remember one thing, it's a very good way of creating of actually scoring marks, which is to calculate materiality. Wherever you see any number, just calculate the materiality. Like if I see over here, I'm seeing number for 100 million has been invested in the design and in the design of the games. So if I see that 100 million has been invested in the design of the game, so I could probably say that 100 million divided by total assets. 100 million divided by total assets can actually give you the materiality of this amount, and when you calculate it, you will get half a mark or at times 1 mark also. Number 2, it says that the deferred income recognizes 18 million. So the deferred income which is recognized is 18 million again divided by the total assets. And then if I talk further, I would say that there is 8 million of the investment, and the investment is to be now written down to 6 million. That means you could calculate it 2 ways. One of them is 8. One of them is actually you can calculate it 2 ways. One of them is it could be 6 divided by total assets, or it could be D2 divided by the profit before tax. Why? Because it would impact the profit and loss account. So you can calculate the materiality for the different items that are available, and based on that you could actually make your comments also if it is material or if it is not material. So you'll get marks for mentioning the materiality also. So I will keep it till here, and I'll answer your questions for 2-3 minutes, and then I'm gonna head for the break for the namaz. If anyone has got any questions, please. Actually, yes, what you have mentioned is actually a business stress generally. As if you don't have to divide the risk into control, inherent and detection risk. That's an F8 level. You are no more into F8, so you don't need to do that. Shirley, I am unable to understand your question. Usman Khalid, I did discuss about the difference between the audit risk and the risk of material misstatement. That risk of material misstatement is basically the audit risk is made up of risk of material misstatement. So whenever we say audit risk, it's a risk of material misstatement multiplied by the detection risk. Okay, Rimsha, the risk pertaining to financial asset is whenever we talk about the financial asset. So financial asset, if it's a short-term investment, the short-term investment has to be recorded at fair value through P&L. And when we talk about recording it at fair value through P&L, this actually means that you have to measure it at fair value at each reporting date, and ultimately you need to continue to record it at fair value at each reporting date. And if there is any gain or loss, it has to be taken to P&L. So the risk over here was, we do know that they have not recorded it at fair value, and now the risk is that we doubt them and we think that they will not record it at fair value. Junaid, there are no presentation slides for second day. The only thing that I am using is this Word document. I can divide it. Okay, deferred income can be divided with total revenue also, Azam Shehzad. Sadullah Khan, you don't have to draft the answer in bullet form. Please draft it in the short paras. No, you need to talk in general that it is not it's an audit risk. You don't have to specifically identify that it's inherent or control or detection. Okay, Hein, I'm gonna take it forward from your point that you will find answers, and those answers would say that it would lead to overstatement or it would lead to understatement. That is one of the ways of actually presenting it, but then again, you will not find every now and then that the examiner is saying that, so it's not necessary. Vagina, no, you don't have to discuss accounting treatment in detail. You just have to assume that the examiner knows the accounting treatment because it's an audit paper. Yes, Asghar Khan, drastic changes in percentages could be misclassification, could be wrong preparation of financial. Okay, okay, Danish, I'll share about how to determine materiality. Um, Hein, you mentioned that I picked non-compliance with government regulation as audit risk, although it's a business risk. So I'm going to share that the code of corporate governance is being developed in order to ensure that that there is a proper supervision on the management, and that management does not, there is a proper supervision in the management, so that is important. So that's why I classified it as a financial risk, that it could lead to weak controls, and weak controls could lead to the problems. And okay. Okay, Sania, deferred, can we talk about disclosures? Yes, you can. Those I told you that 17 marks divided by you do 1.5, you'll get the answer. Okay, Shirley, I said that one of them could be misclassification, and the other risk could actually be that there is a weak control over the cost. Political environment is a business risk, it is not a audit risk. Materiality can lead to half a mark or for 1 mark also. Mohammad Adil, in this case, they had already calculated they've already performed the analytical on their own. They have calculated the ratios. You don't have to do that, but otherwise you can always do it. Okay, let's take a break and then we'll join after the break. Okay, welcome back, everybody. Let's we will resume the session. We'll resume from where we left before the break. So up till now, what we have actually, I think the voice is going to be better now. Because I think during the break, the problem the technical team has tried to fix the issue. So I hope that it's quite better now. Um, okay, anyways, let's move forward. So I discussed with you yesterday also that when the examiner's question requirement is that you need to recommend the audit procedures. So I discussed with you people that how to actually design the audit procedure. So when we talked about the audit procedure, we said that the audit procedures are actually there to test if the audit risk prevails or not. And what is the audit risk? Audit risk is we check if something has gone wrong, and then audit risk is basically we think what could go wrong, and the audit procedures are actually to check if something has gone wrong. So now over here the examiner says that recommend principal audit procedures to be performed in the audit of portfolio of short-term investments. So it says short-term investments portfolio and the earning per share. So now what I would actually ask you people to do is that it's actually a requirement of 8 marks. So you could allocate 4 marks to each of them. That means 4 marks means 4 procedures. Now 4 marks means 4 procedures. So that means first of all you should know that what could be the risk associated with these. And once you know the risk, that you can actually write down the procedures. So I would give you 2 minutes that you can actually think about, you can actually try to identify that what could be the problems with this specific. Okay, let's just discuss about the various audit procedures. So I'm going to talk about it. Number one of them is the portfolio of short-term investments. So when we talk about the portfolio of short-term investment, we need to think what could go wrong. So we need to think what could go wrong with these portfolio of short-term investment. So the number one of them is actually the risk. The risk pertaining to this short-term investments is, number one of them is you need to think what could go wrong. Now what could go wrong? I'm thinking that the cost was not 8 million. They are claiming it to be incorrect, that the cost was not 8 million. That's one of the risks. And at the same time, the fair value at year end is not 6 million. And the third one of them is basically they have not remeasured to fair value. They have not remeasured to fair value at year end. The fourth one of them is it's not a short-term investment. Fourth one of them is it's not a short-term investment. These could be the various risks that I have actually identified. Now, so I told you yesterday also that once you have identified the audit procedure, now what you need to do is that you need to once you have identified the audit risk, now you need to perform the procedure. Now what is the procedure that we'll perform? So if I say that my risk is that the cost is not 8 million, okay, so how would I verify the cost? It's very simple. The very simple thing is you need to inspect the agreement to purchase short-term investment to confirm cost of $8 million. That's one of the procedure that you'll perform. Now my other risk was actually, I said that I think that the fair value at the year end was not 6 million. So what will you do is that you will obtain those published data of fair value to confirm fair value at year end of $6 million. Another risk was that we did identify that they have not remeasured it to fair value. Now, as an auditor, what we do is that we discuss with management, we discuss with those charged with governance, and we try to convince them that they should actually get it measured, that they should remeasure it. But there could be a possibility that they would not actually amend the financials. So the audit risk actually becomes that they have not amended the financials. So the procedure would be to basically inspect the financial statement to check if the investment has been remeasured to 6 million. Is basically inspect trace investment in financial statement to confirm it's recorded at fair value. So these could be the risk, and then there is this another risk that this might not be a short-term investment. So when there is a risk that this might not be a short-term investment, so what could we do in order to verify this risk is that we could actually inspect board minutes, BOD minutes to confirm investment intention. So this is actually done over here. Now let's move forward and let's just talk about you can demand written representation. The third one of them is basically inspect the board minutes. No, not the board minutes. You could actually trace the financial statement to actually to confirm that it has been shown at the correct value. Recomputation of fair value could also be one of the things. Well, the point is, it's actually right now we are talking about the investment. The shareholding pertaining to the family, that's a different thing. That whether that's a related party transaction or not, that's a different thing. We are right now talking about the audit procedure pertaining to the short-term investment. Now, let's move forward. Another risk is basically you need to perform the EPS. It says that short-term audit procedures on the EPS. So I'm just going to write down that what could be the risk with the EPS, because you see all that we do is that we think what could go wrong. So when we talk about the EPS, so what could actually be the risk with the EPS is that when we talk about EPS, when we talk about EPS, so one of the thing is with respect to the EPS is that profit not corrected, because over here we could see that he has used the incorrect profit. Then the weighted average number of shares not correctly calculated, diluted EPS not disclosed. So you need to think what could go wrong. Once you have thought what could go wrong, then all that you need to do is that you just need to actually develop the procedure. You just need to check if that has gone wrong or not. So that's it from this specific question. I think that's a very comprehensive evaluation of what we have done with respect to the various audit risk and all. We are now going to move forward and we are going to discuss further. So the next area that I'm going to move on, in fact, if anybody has any questions, so you can actually ask those questions right now and we can then move further. In the exam, you don't have to. Wajia Khalid, yes, the CATs, the computer assisted audit techniques could be used. Sufficiency of disclosure for 8 million, yes, that could also be an issue, that they have got insufficient disclosure, because when it comes to IFRS 7, which actually requires the disclosures for the financial instrument, so there could be a problem that there is no insufficient disclosure. Rabia, I answered your question regarding materiality. I told that materiality should be calculated. I actually discussed about calculation of materiality, so you did get the answer. Mariam, related party not disclosed as an audit risk. Waqar Mohammad Khan, IS 40 is only applicable to land and building. Faris, I've got limited number of handouts which I can share over here on the group on this specific webinar, but I can share a list of audit procedures in the WhatsApp group that I have actually created for this webinar. So I've shared the link with you people also, so I would do that. Anas Tayyib, why are you unable to come up with the procedure? What's wrong? Salman, that's too hypothetical. It says that okay, Anas, you will develop it. Don't worry, you will develop it. Just try to identify the risk and automatically you will develop it. Can somebody please share the WhatsApp group link over here on this chat so that they can join it? Wali, the point is that there could be the case that the audit risk could carry 2 marks or 2.5 mark also. But remember that the examiner do know that how many points you can write in the given scenario. So automatically you don't have to worry about it. You just think about 1.5 mark per risk. Okay, let's move on to the next area. So okay, now, so we have actually discussed this thing, The initial stage is actually the planning stage. And in the planning stage, what we do is that we understand entity for the understanding of the entity, and we understand the environment. So we have attempted the question related to that, which is actually about the calculation of the business risk. And we understand the entity and its environment, and we have assessed the risk of material misstatement. So we have gone through questions pertaining to that. And we have even performed the audit procedures also. So we have probably gone to the audit performance stage also. That's what we have done. Now, so planning is done and the performance is sort of also discussed. Now, the next stage is actually about the review stage of the audit. Now, you would say, what is a review stage of the audit? So, see, once what happens is generally it's the senior personnel who are involved at the planning stage. And the senior personnel actually plan out, because planning is a very strategic task. Then what happens is majority of the juniors, and definitely they are being supervised by some seniors, they perform the audit. And once they perform the audit, they bring the working paper to the manager or the senior partner who actually reviews the working paper. So this specific stage is termed as review stage or finalization stage. So what we have done till now is that we have not attempted the question pertaining to this review stage. We're going to start discussing the review stage, and we're going to start attempting the questions pertaining to the review stage. So examiner has got a typical requirement at the review stage, and the typical requirement is the examiner's question would always be like this: comment on matters to be considered and state audit evidence that you would expect to find in your review of audit working papers. So that's what it says. Comment on the matters to be considered and state the audit evidence that you would expect to find in your review of the audit working paper. So if I talk about it, number one of them is when it says comment on the matters to be considered. When it says comment on the matters to be considered, so what exactly do you mean by commenting on the matters to be considered? So commenting on the matters to be considered is basically there was an article from the examiner, and in that specific article the examiner gave guidance that what exactly do you need to do. So when we talk about comment on the matters to be considered, so you need to actually, first of all, you need to talk about the materiality. You need to talk about the materiality of the matter, if the matter that is under consideration is material. And then you have to talk about the accounting treatment. And then you have to talk about the accounting treatment. So one of them is materiality. The other one of them is an accounting treatment. So when the question says comment on the matters to be considered, so you discuss about materiality, whether this is a material matter or not. And the second one of them is the accounting treatment. And the third thing that you do is that when it says and state the audit evidence that you would expect to find in your review of the working papers. Now, very important area. I'm sure a lot of you would have made mistake in this area also, because this is an area which is not well understood by the students. So as it says, comment on matters to be considered and state the audit evidence that you would expect to find in your review of the audit working paper. So let's just talk about it. We'll discuss that what exactly is it and how would we actually deal with it. So see, I discussed that when it says comment on the matters to be considered, so what do you need to do? You need to discuss the materiality and you need to discuss the accounting treatment. And it says state the audit evidence that you would expect to find. Now, you need to understand what is audit evidence. You need to understand what is audit evidence. Now, there are two things. First of all, there is a difference between audit procedure and there is a difference between the audit evidence. Now, what is the difference between the evidence and the procedure? The procedure is actually an action. Whenever we talk about the procedure, so the procedure is actually an action. Whenever we say the procedure is actually an action. And when we talk about the evidence, so the evidence is result of an action. Evidence is result of an action. So if I say audit procedure is you performing an action. The evidence is the result of the procedure. So usually the students, when the examiner asks that state the audit evidence, you would expect to find the students end up writing down the audit procedure. They are unable to differentiate or distinguish between the evidence and the procedure. So I'm going to explain to you what is evidence. I'm going to explain to you what is procedure. Let's just try to understand this. I will take an example, and that example is that there is an audit risk. And what is that risk? That property, plant and equipment are not correctly revalued. That means the entity has revalued its property, plant and equipment, and we think that there is a risk that they have not correctly revalued it. Okay, so now this is the audit risk. What am I gonna do? I'm gonna perform the audit procedure. I'm gonna perform the audit procedure. My audit procedure is going to be, I will inspect valuer report to confirm fair value of $35 million. Now see, you faced a risk, you perform a procedure for that. Now what next? What is the evidence? Once you have performed the procedure, so the important thing over here was the valuer report. You would have definitely copied the audit report and would have kept a copy of it in the working papers. So what evidence have you gathered out of this whole exercise? The whole exercise has resulted in the evidence, which is the auditor's report. So the whole exercise has resulted in giving you an evidence, which is the valuer report. So you see, you understand the difference. What's a basically audit evidence and what's a procedure? Procedure is an action. The evidence is the result of an action. So the examiner says, state the audit evidence that you would expect to find in your review of the working paper. So how would you actually write down the answer to it? You would say that I would expect to find valuer report confirming fair value of $35 million. I would expect to find a valuer report confirming fair value of $35 million. So now you understand the difference. What's procedure, what's evidence. So it's all derived from the risk. Once you know the risk, you can do the procedure. You can do the procedure, you can write down the evidence also. But from the exam perspective, all that you have to write is this area. Now, one more thing. At times, in fact, the examiner has himself mentioned in his article that at times the student, they mix up the audit evidence and the audit procedures. So what to do then? So what to do then is that you don't have to give up. You don't have to actually worry. The only thing that you do is that once you have discussed the matters, so you discuss the materiality and you discuss the accounting treatment. You discuss materiality and you discuss the accounting treatment. And then what will you do? You would say that you would write down a line. I would expect to find following evidences in my review of audit working papers. I would expect to find the following evidences in my review of the audit working papers. Once you have written down this line, now after this, once you have written down this line that I would expect to find the following evidences in my review of the audit working paper, So even if you end up writing the audit procedure below that, the examiner would understand from the line that you had mentioned that these are the audit procedures that you have written. So the examiner would understand that these are the audit procedures that you have written. So understand, it's about the accounting, it's about the materiality, then about the accounting treatment, and then you would actually write down, I would expect to find following evidences in my review of working paper, and then you write down the, even if you write down the procedure, that is okay. Tala, obtain the copy is basically is not an evidence, it's a procedure. No, you don't have to explain the accounting treatment that client did. You just have to explain what should be done in the given scenario. I'll just explain one or two questions to you so you'll get an idea. So let's come on to the question. Let's come on to question number 4 of June 2017. It's a hybrid paper. It's also available in the handouts. You can actually open it up. So please come over to this question, and it's a 20-mark question. I would give you 5-6 minutes. You read this question and then we'll discuss. Yes, Usman, you need to write down that why exactly are you performing this procedure. You can take 2 more minutes and then we will start discussing. Get Uwais' question is available in the handout. Well, the point is, Hassan Shehzad, if you don't mention that why have you performed the audit procedure, then what is actually going to happen is how would the examiner understand? This is actually going to be a problematic situation if you don't mention that, because there has to be a reason for evidence. What are you trying to verify from that evidence? Okay, let's start discussing this question. Um, okay, anyways, let's just discuss about it. So we'll start discussing this question, and we will discuss that this question, it says, anyways, I think there is something wrong with the system that I'm unable to actually open up this question. Anyways, let's see, you are the manager responsible for the audit of Ossier Company, a jewelry manufacturer and retailer. The final audit for the year ended 31st March 2017 is nearing completion, and you are reviewing the audit working papers. The draft financials recognize total assets of 1919, and it was 1889 in 2016. So one thing that you will do is that you would say that whenever I've told you that whenever you come across the number, all that you need to do is that you need to perform the analytical procedures. Now, what do you mean by performing analytical? It's 1919 minus 1889 divided by 1889, so you get the percentage change in the assets. Now, why are these percentage changes important? Because once you come across these percentage changes, these would actually help you highlight a lot of areas. The second one of them is revenue, which is 1052, and last year it was 997. So it's 1052 minus 997 divided by 997, approximately 5.5% increase. And then we have got the profit before tax, and the profit before tax has actually gone down by 3 million on 110 million, gives you a negative something like let's say it's something like 2.8%. That's what it is. So 5% increase in sale, 2.8% decline in the profit, and if we say it's around 2.5% increase or 2% increase in the total assets. Now what next? If you talk about it, the question's requirement is same, which is comment on matters to be considered and explain the audit evidence you should expect to find during your file review in respect of each of the issues described above. Now, you need to try to understand this thing, that what do we mean by comment on matters to be considered. So when we talk about comment on matters to be considered, to think generally as an auditor that what will you do when you will come across such a matter. So what will happen is, you are a manager responsible for this audit. If you come across this specific matter, the first thing that you will do is that you would try to calculate the materiality. You would try to calculate the materiality, that is the matter under consideration material or not. And then what you will discuss is, you actually the past exam questions indicate there could be two types of things, which is you would discuss as an auditor that what are the factors which you are considering. Like it could be the accounting treatment rectification, it could be the various risks associated with this matter. So there could be these things which you could write. So you could write about the accounting treatment, you could write about the various risks, associated with this matter. So it says inventory costs include all the purchase costs and the cost of conversion of raw material into finished goods. So and the conversion costs include direct labor costs and an allocation of production overheads. Direct labor overheads are calculation based on average production time per unit of inventory, which is estimated by production manager multiplied by estimated labor cost per hour, which is calculated using the forecast annual wages of production staff divided by the annual scheduled hours of production. Production overheads are all fixed and are allocated based upon forecast annual units of production. At the year end, the inventory was valued at 21 million. Last year it was 20 million. So if I talk about this 21 million, I would say 21 million of the inventory upon 1919 as an asset. So can somebody write down how much percentage is it? Can somebody please write down what percentage is it? Okay, so this is actually 1%. The inventory is 1% of this overall total assets. Okay, Mariam, I've tried to calculate the materiality of the inventory. And how do we actually determine the materiality of the asset? We determine the materiality of the asset by simply dividing the value by the relevant figure. So here if I say it's 21 million, which is the carrying amount of the inventory, and it's being divided by 1919 million. Okay, so thank you. And it's 19.6% of the profit before tax. So 107, it's 19.6%. Now, I have told you earlier also that materiality is a judgmental matter, and generally we do use different thresholds. Like we use 5% of the PBT, we use 2% of total assets, we use 1% of the total revenue. We do use various materiality thresholds. Okay. Now, so this is actually, so the first thing is what you would do is that you would, whenever you come across such a thing, you would say that inventory is 1% of the total assets, or inventory is 19.6% of the profit before tax, therefore it's material. Now you would say, why is it 19.6%? Why have you done it? Because you see, what happens is the inventory is used as sales, and it's used in the cost of sale calculation. So it's opening plus purchase less closing stock. So when we talk about closing stock, that means the inventory is mentioned in the profit and loss account also. Then that means this has an impact on the overall profit that's being reported. So the inventory is also relevant to the profit before tax. So you need to see if it's relevant to balance sheet, if it's relevant to revenue, if it's relevant to profit. That's what you need to see. Now next. So that is one thing. Now what happens is you need to talk about the accounting treatment for the inventory, or the various other matters that you think as an auditor that you might actually have to consider in this specific scenario. So if I talk about it, let's just start discussing. So what would happen is, now they say that inventory include, generally speaking, the inventory's cost is determined this way, that is the purchase cost plus the conversion cost. So over here, apparently the accounting treatment that they have done apparently seems to be correct. So what should I do? Should I not talk about the accounting treatment? Apparently no, I don't really need to talk about the accounting treatment, but Do I have any other matters which I am considering as a manager? Am I considering anything else? Yes, I am considering. What am I considering? It says conversion costs include direct labor costs and an allocation of production overheads. Direct labor costs are calculated based on average production time per unit of inventory, which is estimated by the production manager, multiplied by the estimated labor cost per hour, which is calculated using the forecast annual wages of production staff divided by annual scheduled hours of production. Now, my risk. What is gonna be my risk? I'm telling you that accounting treatment apparently seems to be okay, but my risk are that I think that there is a risk. And what is that risk with respect to this inventory? The risk with respect to this inventory is that the inventory is overstated. Now, why would the inventory be overstated? Because it says that the labor cost is based on estimate. The labor cost is based on estimate. You don't have the actual data. It's just an estimate that how much time will it take to produce one single unit. So it's actually going to be, number one, the labor cost is estimated in terms of the time taken. The labor cost is very rough estimate based on the time taken and also based on the forecast wages, because it does not actually consider the actual wages. It's based on forecast wages, and furthermore is based on budgeted production hours. So although yes, IS2 does says that these are the things you need to consider, but then again, the cost, the average time taken is estimated. You don't have the actual figure, so there is a risk that the inventory might actually be overstated. Now what next? It says production overheads are all fixed and are allocated based upon forecast annual units of production. That is also fine. But then again, there is also a risk, which is that if the actual production exceeds the forecast annual production, then there would be over absorption of overheads. So if there is an over absorption of overhead, that is also a risk. So over absorption of overheads could also be one of the risks. So now if I say my point to this specific question is, I've discussed that is it a material matter? Yes, it's a material matter. Okay, then do we need to comment anything about accounting treatment? To me, the accounting treatment seems to be okay because that's how the inventory is accounted for. So that's why I didn't say anything on accounting treatment. But do I actually have any other thing to consider? Yes, I'm facing a risk. I think there is a risk. There's a problem. This inventory might be overstated. Okay, so I should write that. Once I've done that, now what happens is the evidence comes in. So I would say I would expect to find following evidences in my review of audit working papers. And then you would actually write down the various evidences which you would expect to find. So if you people could actually think for a minute or so that what could be the procedure, evidences which you could find. Okay, I'm just trying to open up the answer to this question. Unfortunately, there's something wrong with my system, that it's unable to deal with this um, thing. But let's just have a quick discussion on this inventory and all that. So you see, as I told you earlier, that the evidences are derived from the procedure, and the procedures are actually developed in order to address the risk. So what are the risks that we face in this scenario? So I personally think that it says inventory costs include all purchase cost and cost of conversion of raw material into finished goods. So the purchase cost, my risk could be that the purchase cost is incorrect. I would perform the procedure to basically see if the correct purchase cost has been recorded, but the result is the evidence is going to be the purchase invoices or the purchase summary. Purchase invoices or purchase summary to confirm that the purchases have been correctly recorded. Number 2, conversion costs include direct labor costs and an allocation of production overheads. Now direct labor costs are calculated based on average production time, so incorrect labor cost. So how would I actually, if this is an incorrect labor cost, how would I actually deal with it? I would actually discuss with the management, and I would ask the management that I might actually have the audit procedure would be recalculate the labor cost. So my evidence is recalculation statement of labor cost. They would have performed the procedure, and I would find the evidence pertaining to that into it. Then I also face a risk, which is basically the forecast annual wages. So I will have forecast of annual wages also. I will have forecast of annual wages also. Then at the same time, if we move further, it says production overheads are all fixed and are allocated based on. You might actually have the breakup of production overhead. You might actually have the breakup of production overheads. So when you have the breakup of production overheads, so breakup of production overhead would reveal if they are fixed nature or not. So breakup of overheads to confirm if they are of a fixed nature. So that's how you actually answer this specific question. Hasan Khan, what is it that you are unable to understand, please? Hasan, this is there in the handouts. You see this webinar, you will find the handout, or you can direct it from the website. Yes, Poonam, you have to write the various, you see, what are the various issues that you could think out of it when you've come across a scenario. So you write the accounting treatment, plus what are the various risks that you actually think in this scenario. So when it says matters to consider, so the matters to consider is actually all about that what are the factors that you are considering as an auditor. Okay, let's move forward and okay, Ravin, how 7 marks are allocated? 7 marks are allocated this way. The that you would have 1 mark for materiality calculation, you would have 2 marks for the accounting treatment and risk, and then you will have the remaining marks for the evidences. Yes, you can obtain payroll sheet. You can do whatever that could help you verify the thing. So my point is, then again, it should be that you should be able to identify that what exactly is the risk, because till the time you don't identify the risk, you can't actually perform. You cannot actually write down the evidence. So let's move forward and let's just discuss about the next part B, which is about impairment. We have got less amount of time, so we would actually try to do it quickly and discuss it so that we can actually move forward now. It says that the year-end management performed an impairment review on its retail outlets, which are a CGU, for the purpose of conducting an impairment review. While internet sales grew rapidly during the year, sales from retail outlets declined, prompting the review. At 31st March, the carrying amount of the assets directly attributable to the retail outlets totaled 137 million. This includes both tangible and intangible. So if I say 137 divided by the total assets of 1919, what percentage is it, please? How much percentage is it? Okay, 7.1%. Let's move forward. So that is one thing, which is 7.1%. If I move forward, it says during the year, management received a number of offers from parties interested in purchasing the retail outlets for an average of $125 million. They also estimated the disposal cost to be 1.5 based upon their experience of corporate acquisition and disposal. Management estimated the value in use to be 128 million. This was based upon historic cash flows attributed to retail outlets inflated at general rate of 1.1%. This, they argued, reflects the poor performance of the retail outlets. Consequently, the retail outlets were impaired by 9 million to restate them to their estimated recoverable amount of 28 million. The impairment was allocated against the tangible assets of the outlets on a pro rata basis based upon the original carrying amount of each asset in the unit. If I say that this impairment, you see, generally what does IAS 36 says? IAS 36 says that when is impairment gonna take place? Whenever the carrying amount of the asset exceeds its recoverable amount, and the recoverable amount is the higher of fair value less cost to sell and the value in use. The recoverable amount is the higher of fair value less cost to sell and the value in use. So now what they have actually done is they identified the fair value less cost to sell to be 125 minus 1.5 gives you 123.5, and they identified the value in use to be 128 million. This is what they identified. So they identified the recoverable amount to be 128 million, and since the carrying amount was 137, so 137 minus 128 gives you a 9 million impairment loss. That's what they have recorded. So one of the impairment loss, one of the calculation is this 137, and the other calculation is 9 million on a profit before tax of 107 million, which is approximately 8 some percent. So it is actually a material item. So number one of them is actually it's a material item. The accounting treatment has been done correctly, but now then again, as an auditor, I think there are certain risks attached to it. So I'm going to write down those risks. Now what are those risks attached to it? Number one of them is the $128 million estimate of value in use is based on historical cash flow. Although whenever we calculate the value in use, so we actually have to, it's based on historical cash flow increased by a general rate of inflation of 1%. So this 128 million of value in use based on historical cash flow inflated by 1% seems to be apparently incorrect. Now, why does it seems to be incorrect? The reason behind that is the market is changing. Now, what is the market change? The market is changing towards the internet sales. So if the market is changing towards the internet sales, then how could you expect the retail sales to go up? You can't expect the retail sales to go up if the internet sales are actually going up. So even if you are incorporating a general rate of inflation, that means you are assuming that the retail sales will stay at the same level that they are staying right now, which is highly unlikely if the internet sales are growing. So apparently the value in use that they have taken is incorrect, which means that the assets are overstated, which means that the assets are overstated. So that is one thing, and furthermore there could also be another issue, which is the allocation of impairment loss to the cash generating unit. You've allocated this impairment loss to the cash generating unit. So now generally you would talk that this is a material item because it constitutes 7% of the total assets and 8% of the profit before tax, and furthermore the accounting treatment apparently seems to be okay, but there are problems with respect to yes, Abhi, this is how this is how you have to do. Okay, now next. So what you need to do then is that you need to actually talk about the audit evidences. So what would be the probably the evidences? When we talk about evidences, then we could actually talk about that what see you need to think that what constitutes, because you see, as an auditor, what am I going to check? I'm going to check the risk that I'm facing. My risk are that this value in use is incorrect. Okay, how would I verify if the value in use is correct or not? So the simple thing that I need to do in order to check if the value in use is correct or not is that I need to have a copy of historical cash flows. I need to have a copy of historical cash flows. I need to have a recalculation of future cash flow, and I need to have a written representation from management confirming why the cash flows will arise in future. And then if we talk further, we would have the allocation statement, we would have the recalculation of impairment loss allocation also. For the disposal cost, you could actually inquire from the management how did they determine this disposal cost. So the management might actually tell you that there is a practice with the past that if you sell something, then if you sell something, then this is what the general criteria is in the market, that this is the amount that you have to pay. So basically what would happen is that you would inquire from the management, and you would actually, the management's written representation could be there about the disposal cost, that what is the cost that it takes to dispose of an asset. Okay, is that fine now? So I think it's already 8:54. We shall keep it till here, and if in case if somebody has any questions, we can answer those questions, and we'll take it forward from here for the tomorrow's session. So could you please inquire if there are any questions that you have, and I'm going to answer this. See, there is no subsidiary. He's not talking about any subsidiary. There is no subsidiary, so where does the goodwill comes into play? The goodwill only comes into play when there is a subsidiary. So that is something that you should not discuss. I mean, why do you need to discuss? No, allocation of impairment loss is not as per IS 38, it is as per IS 36. Okay, Anas, we'll see. Okay, first of all, it has to be allocation onto the goodwill and then the remaining onto the assets. My mistake on that. Okay, Rabia, for tomorrow we are going to discuss the group audit, and along with group audit we will also discuss the audit reporting. That is our plan for tomorrow. So it's going to be group audit along with that audit report, and we'll try to do 3 questions. And those 3 questions are going to be, one of them is going to be from, I would actually share the questions in the group, the WhatsApp group, the questions that I shall be doing, because I need to actually rethink about the strategy for tomorrow. So I'm going to share it in that. And can somebody please share the WhatsApp link again onto the group so that other people can also join following that link. Okay, anyone else has any other question? Okay, Tala, please go ahead. Hassan Shadat, can you repeat your question, please? Ishfaq, I am there to reply. Please ask any questions that you have. Mohammed Tala, with respect to what the impairment could be basically you could inquire from the management the past record, the future forecasted sales, and how the internet has been affecting them. You can actually take all these things from them. Yes, Hassan, we can discuss the risk also, but not in the review. I mean, we can actually see it's all about having matters to consider. You come across such a issue, you've actually come across this specific scenario, so you would consider the materiality and you would say, okay, this specific matter has etc problems also. So you see, you are a manager level, and being a manager, you would actually see that if I am actually reviewing the work, then what are the risks that prevail? I mean, what is it that I need to look at? So it says comment on matters to consider. Salman, it's not important to write the question plan. You don't have that much time that you can write the question plan. Yes, Poonam, you can write down without the headings also the business risk. Rarvin, it's not about 2 lines, it's about 2 points. So if your 2 lines can have 2 points, that's all okay. Okay, the evidence is written representation from the management. I mean, Rabia Khalid had a question that for audit evidence, we need to write risk, then procedure, and then Abir had a question that what will be the evidence if there's an inquiry with management? It's going to be the written representation. Rabia, no, you don't have to write the risk, you don't have to write the procedure. It's just that you have to write the evidence. I'm just trying to explain to you people. That's why I'm actually writing down the risk so that you could derive from it. Ishfaq Ahmad, you would only figure out basically if there is a balance sheet item, it has to be divided by total assets. If an item is actually expense related item or other income related or etc., that's a P&L item. Like for example, we had an example where there was a financial asset of 8 million. So 8 million and it was at year end it was to be written down to 6 million. So the 6 million was a balance sheet item, so it should be compared with total asset. The 2 million was a P&L item, it should be compared to the profit and loss. Rohit, you are right. In practical word, it's different for every single line item for balance sheet for P&L, but from the exam perspective, you just focus on this. Yes, Wali Daniel, you could actually obtain the bids that has been there from these agents and all that. Bilal Qasim, how many times will you write the accounting standard? It's not an accounting paper, it's an audit paper. You're not going to get marks by writing down accounting. So please avoid accounting, writing down accounting again and again. Rizwan, your suggestion taken, but I think the Telegram is not that commonly used. So WhatsApp is something. I mean, if somebody is concerned about their privacy, I mean, alternatively, we could have some other medium also. I'll see if I can have some Telegram. Rabia, your question that for the audit evidence question, yes, you have to calculate materiality, then you have to write accounting treatment, then risk, and then those things. Yes, Ashfaq, I answered your question. Yes, Vajiha. Poonam, my suggestion would be attempt question number 1 first. Rarvin, that's what I told you that you can write down. I would expect to find following evidences in my review of the working paper, and then you can write the procedure also. Muhammad Tala explained that evidence is basically evidence is the result of an action. The procedure is an action. So that's where the difference lies. Akshay, I would try to put that across through email also. Yes, Rabia, I'll share the important past paper also. Wajiha, I would suggest do question 1 and 2 first because that's a mandatory part. So it's 60 marks which you have to attempt in any case. So I would suggest that you go with question 1 and 2. Yes, Wali, you can have the evidence with respect to goodwill also by extracting the financial statements. Wali, my contact number is there on the WhatsApp group. So it's actually it's known to everybody. But I'm usually unable to I'm usually unable to answer the phone calls. So, I mean, if you send across message, I would suggest that you send across on the WhatsApp. That would be a better option. Yes, Arvind, we might actually go through that article. Rabi, I'll try to share the notes on that the group also. Okay. And I would suggest that you could also ask the questions to me from me on the Facebook also. Yes, Rarwin, we will cover up. I think the lecture plan has been shared with you people. Anyways, Wali will see if I can do that. Thank you very much, everybody. Thank you for your time. I mean, you can find me as Muhammad Luqman Rafiq. Uh, Thank you very much, and I think the ACCA team needs to know your feedback, and I also would appreciate if you could share your feedback on the session so that if we could improve it further for tomorrow. Okay, thank you very much, everybody. Thank you for your time. See you all tomorrow, inshallah.